Welcome to Deloitte's Debriefs Tax webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and it's titled Double Tax Treaty Update. My name is Chris Roberge and I'm a tax partner based in Hong Kong. And today I have the pleasure of hosting today's webcast. I also have two of my favorite speakers with me today, Gokul Chaudhary and Claudio Cimenta. Gokul is a tax partner based in India and Claudio is one of our partners based in Australia. Just a little bit of housekeeping before we get started today. You may access our bios on the left-hand side of the screen. And before I introduce today's agenda, I also want to highlight some of the features of our webcast. For many of you, this is all familiar, but for some, this is maybe your first time. All users are on listen-only mode. If you have any content-related questions, you can submit them at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation, and if not, we'll try and get to them after the call. Secondly, all PC users can maximize or minimize each box at your convenience during the webcast. And you may also explore the icons at the bottom of the screen. And if you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, anybody who's on a mobile device, you can view the slides and you can still also answer the survey questions. And third and finally, if you do require an attendance record for this event, you can download your CP certificate by clicking on the Request CP icon at the bottom of the webcast console. And so with that, and no further ado, let's jump right into today's webcast. So today I hope you find a very interesting webcast. Obviously, it's focused on double tax treaty updates. It is an update from what we provided at our Global Tax Conference in April. The key things we want to cover today is to provide a bit of an overview of where all the tax treaties are at in Asia Pacific. So instead of diving down into the very particulars of treaties, we're going to step back for a moment and just do an overview of the strength of the relative treaty network in the region and some of the interesting comments around that. Then Claudio is going to take us through an analysis around principal purpose test. You know, this is something we've talked about quite a bit, but I think now we're getting more experience. We're going to dive into that a little bit more. And then thirdly, a key area today, Gokul is going to talk a bit about permanent establishment, PE, and residency, and some of the changes that have happened in that regard. And then throughout this process, we're also going to bring in some relevant treaty cases, other developments, and probably have some good discussions as we go along. So with that, let's kick off with treaty status. So we try to provide a pictorial of kind of where things are at, and I hope you appreciate kind of the image that's being presented here. But one of the interesting things that we've found when you take a look back at what's happened over the past decade in Asia Pacific is really a few things. Firstly, if you look at just the sheer volume and number of treaties that Asia Pacific has, it does have a lot of treaties, and almost as of now, virtually every economy in Asia Pacific has more than 40 income tax treaties. And virtually all of those treaties are with the major trading countries. And if you do a little bit of kind of reverse math, you will find that these treaties represent well over 90% of the global GDP. So it's fair to say that Asia Pacific is a treaty jurisdiction. I think what's also interesting to note is just how that was not necessarily the case 10 years ago. Countries such as Hong Kong did not have an elaborate treaty network back in 2010. It's now fair to say it does. Okay. Similarly, you see significant treaty growth in even mature countries like Japan, but also India, Vietnam, etc., Singapore have continued to expand their treaty network. And you can see places like China, despite all discussions around trade and everything else, it has the largest treaty network in the Asia Pacific region with well over 110 tax treaties. Next slide. The second thing we want to take a perspective on was, so you have all these treaties in Asia Pacific. Do they cover the major economies? And I think what's interesting to note here, if you look across the top axis, you'll see most of the major non-Asia Pacific economies listed. And down the left axis, you'll see the main AP countries. And what you see with all the check marks is that a treaty does exist. So in this legend, what you can see is a green check mark means that a treaty exists, and it also contains some more favored treaty provisions, such as, say, 5% dividend withholding tax rate, or 10% interest rate, or 10% royalty rate. So you'll see there's a lot of those green check marks. A white check mark means that it has a treaty, but maybe it doesn't have the most favored rate. So maybe 10% withholding tax on dividends. But I think what I'd like to maybe point out here is if you look across all the treaties, although we have lots of treaties, there are still some that are missing. Brazil, for example, tends not to have a strong treaty network with the Asia-Pacific countries. You'll also see with some of the Latin countries, Italy, Spain, Mexico, they do have treaties with the Asia-Pacific countries, but not necessarily the most favored treaties. So they tend to have still more, if they have 10% dividend withholding tax rate. You can also make a note of some of the key treaties that are missing. Maybe the most obvious one is the United States. The U.S. does not have treaties with places like Hong Kong, Malaysia, and Singapore. Okay, and I think there's not any current discussions for that to change either. Similarly, you'll see not all countries have a favored treaty with the U.S. So that's just kind of an interesting observation. You also might note that some of the more traditional European holding companies or tax planning countries such as Luxembourg, Ireland, don't necessarily have as many or as favored tax treaties as well. If you look at Australia, for example, it does not have a tax treaty with Luxembourg, but nor does it have one with Hong Kong. Actually, on that point, Claudio, any kind of thoughts as to whether or not Australia will be seeking to negotiate tax treaties with places like Luxembourg or Hong Kong?
Yeah, thanks, Chris. That's an interesting question. I think the discussion for those two countries is a bit different for each one. With regard to Luxembourg, to be frank, I believe our authorities consider Luxembourg to be, shall we say, a low-tax country, and there's probably not a lot of reciprocal benefit, certainly on the Australian side, for entering into a treaty. So I don't think that is anywhere near the top of the list. Hong Kong is a much more interesting one, particularly in our region. Many of our participants today might be aware that Australia and Hong Kong recently signed a free trade agreement, and it is quite rare for us as a country in Australia to have countries that we have a free trade agreement with but don't have a double tax treaty. So we know that there's quite a lot of enthusiasm, at least until recently, on the Hong Kong side to have that treaty, and Australia is looking to renegotiate. So that might be one that's on the list, but I don't know to what degree other sort of current geopolitical tensions may also affect that. But that is one that would be of interest in Australia.
That's interesting, yeah. I know Hong Kong would like that. And next slide, please. As we turn then maybe from the looking to the non-APAC countries, we've kind of done a similar chart to kind of look at how strong is a treaty network within Asia Pacific. And again, what you can quickly see is that almost the Asia Pacific countries almost all have treaties with each other, absent a few exceptions, which is good. But what you do find in Asia Pacific, though, is they're not always necessarily the most favored clauses. We have a lot of cases where dividends have a 10% withholding tax rate still. The other thing I think you'll find is that there's no clear, obvious country that has the best treaty with every other Asia Pacific country. So, for example, you'll see that Hong Kong typically would have a better treaty with India, Indonesia, versus where Singapore would have a better treaty with Malaysia, Vietnam. And there's other instances of that as well, So it is still important that although tax treaties exist in the region, depending on your needs and your business arrangement, your preferred structure may vary. So there's just no single answer in this region as to what's the best treaty for all circumstances. And I think on that, Gokul, I was kind of curious on India, such a growing and large economy, but it still tends to have, more treaties that are kind of, I'll say, more traditional and have maybe more 10% withholding tax for those types of things, absent the recent Hong Kong treaty. Do you think India is going to change that philosophy and move to lower withholding rates?
Well, until now, most of our dividend withholding rates were at 10%, including with the OECD countries. Hong Kong, in that respect, is a unique treaty. And there's been no public announcement as to why India concluded a favorable rate on dividends with Hong Kong. But one can speculate that most of the treaties that India signed were signed and are quite dated, whereas the Hong Kong treaty is a recent one. And at the point of time that India did conclude this tax treaty with Hong Kong, India did have dividend distribution tax in its domestic regime, whereas the dividend-paying company paid close to 20% tax, and the shareholders were exempt. So I think the giveaway of 5% was notional, because the shareholders were not taxed on their dividend income at the point of time when this treaty was signed. Whereas all the other treaties were actually concluded at a point of time when India had a more classical dividend withholding regime, which now it has reverted to again.
Okay, interesting. Great. So that kind of takes us a bit of a summary of to where the tax treaty networks are in Asia, and I hope it gives you kind of a good overview as to what's changed over the last decade. And I think I said it's fair to say that there is a strong treaty network in the region, but you still need to do your analysis. And I think we're going to talk a little bit more here in a minute about MLIs, and that's going to cause us to reflect upon the how those treaties actually operate in the region. Let's move to the next slide. And I think we want to take a pause here and just get some responses from the audience. So we have a polling question on the screen. And our polling question is, do you foresee a change to the use of Singapore and Hong Kong as traditional regional headquarters centers? And your four options are yes to a significant degree, yes, but only marginally, no impact at all, or not sure. I think, Claudio, maybe one of the strong influencers to this question, maybe however all of our audience members are reflecting upon the OECD's announcement last week around Pillar 1 and Pillar 2. What do you think?
Yeah, that's right, Chris. I think that's the big news in this area. It's affecting a lot of other things as well. But looking at Singapore and Hong Kong, of course, we look at the treaty networks, but tax is far from being the only driver, naturally. But when we look at Pillar 2 in particular, the big question is, how do jurisdictions like Singapore and Hong Kong respond to that? The headline tax rates are above the stated minimum so far that's been negotiated. It could potentially go up. But what do they do about their tax incentives that would fall below that, significantly below that minimum? There's all sorts of talk at the moment about whether those jurisdictions might start to tax some foreign sourced income so that they just don't give up revenue to other countries. That Pillar 2 would say, well, if the income is going to be taxed somewhere, we might as well tax it if someone else would otherwise tax it. And the other thought in those jurisdictions is, well, to the extent that tax incentives or income tax incentives are going to be restricted or effectively neutralised by Pillar 2 minimum tax, is whether those countries might look to non-tax or non-income tax types of subsidies or support to continue to encourage activity in those jurisdictions.
Absolutely, yeah. Well, and I think our respondents are exactly agreeing with what you're saying, Claudio. I think some say there will be some change. My interpretation would be, in addition, to what Pillar 1, Pillar 2, it's just the whole impetus of business transformation change and everything else, and all the broader tax rules changing, that every company is changing some of the structures a little bit. But whether or not it affects the company significantly or no impact at all, you see those results are almost split. It probably really depends on a company's particular circumstance. Interesting. Excellent. Okay. So let's move on a bit then, as we just kind of did a little bit of a introduction or prelude to MLIs. One of the key things around all the BEPS initiatives is to make them effective was for the MLIs to become activated and effective. So in this table here, we provide a short summary as to when they are now in force. You can see Australia is one of the first ones, if not the first one, where it came into force on January 1st, 2019. So, 2 years ago, and is applicable. China, Hong Kong have signed it, but they have not indicated as of yet when those MLI provisions will be coming into force, or when they will be bringing them towards their government to have that enacted. India, as you can see, is in force and effective for withholding taxes as of last April, so effective about 1 year now. And many other countries in Asia Pacific, as you can see, have come into force within the last year or are just coming into force. So, I think this is rather interesting, in the sense where we talked a lot about BEPS, we talked a lot about treaty stuff, and even the stuff we're talking about today. But I'm curious how much we're seeing it change in practice. And Gokul and Claudio, maybe if you guys have a quick perspective. I mean, has your treaty analysis changed And have you seen a change in practice now that the MLI is in effect? Or are we still kind of waiting for the recipient party to also have ratified?
Claudia, you'd like to go first?
Yeah, sure. I think I could do that. Australia was quick off the mark, as Chris observed, but also, as you noted, for this to apply, the treaty counterpart also has to agree, and then it takes effect as between both countries. What we've seen so far, it's still early days, but I've just recently seen the ATO raising the question of the application of the PPT to an inbound investment structure, which, because of the counterparty involved, the date of effect was the 1st of January 2019. So we are now looking already at a couple of years worth of income that's gone through that structure. And the ATO is now starting to look at it. They clearly got that on the agenda. They've issued some guidance. So I think we'll start to see that building now that there's a couple of years of experience of actual cases that are subject to the new rules.
Yeah.
So if you look at India, I think India's treatment around its tax treaties, although we had a wide network, was quite anxious around Mauritius and Singapore, which were the two treaties which were the cause of a significant amount of tax disputes and litigation because of the claims. I think the MLI has come and been very helpful with the PPT test and established credentials on how treaties need to be applied. And India is quite satisfied with that, along with, of course, the fact that India has renegotiated its Mauritius and Singapore treaties. Therefore, the noise around treaty eligibility has actually become far less, and there's greater amount of robustness around the use of treaties now that we've seen the treaty renegotiations having been completed and MLIs having been concluded.
That's nice to hear some good news from India, because it's always been a history of disputes. So it's good to hear more certainty around that. So excellent. And I think, as you said, Claudio, I mean, not just in Asia Pacific where you're seeing entry into force, but I think rest of the world, we're through 2021. I think we expect to see a lot more entry into force into 2021, but obviously with COVID, governments were more restricted on some of their activities. So maybe we'll see a lot more of this kind of come in through the rebalance of this year and early 2022. So I think I'll just ask our readers listeners to follow this closely. As you can see in Asia Pacific, we're ready. In many cases, it's entered into force, and we're just waiting the recipient country, which if it hasn't already done the reciprocal treatment, I think we should assume it'll probably happen fairly quickly. Next slide. The next two slides are just a quick capture of some of the treaties that have happened over the last 2 years. There was obviously more in early 2020 before COVID hit, and then, as I just previously mentioned, with the suspension of many government activities and negotiations, there was a slowdown. So maybe there's been a bit of a pause in the last 12 months, but again, as governments get back to business as normal, I think we'll see a resurgence of new protocols to treaties, as well as hopefully maybe some additional treaties signed. But as we started off in this earlier discussion, there already is going to be a fairly strong, robust network around the world. So I think going forward, there'll be a less of a necessity to create new treaties, and we'll see more just updates and new protocols. So with that, Claudio, let's turn down into the principal purpose test section, and I think I'll allow you to kind of kick that off with another polling question.
Yeah, that's right. Thanks, Chris. So, firstly, to set the scene for this section, we've just got this question: will BEPS encourage me to centralise my holding and financing companies more? We've got our options there: to a significant degree, marginally, no impact, or don't know, not applicable. And whilst we're waiting for the answers to come through, perhaps just to pick up on what we discussed earlier with regard to Pillars 1 and 2, just a question for Gokul. I know we were discussing this earlier when we were preparing for this presentation. We know that Pillars 1 and 2 are going to require some form of multilateral instrument, especially Pillar 1, to implement that, and maybe even for Pillar 2 for coordination purposes. That's what's in the latest announcement. Do you think, Gokul, that the OECD and the G20 and the inclusive framework have been encouraged by the way the MLI has come together to approach pillars 1 and 2 through an MLI type construct. It will be a new one, but do you think that's encouraged them down that path?
So, Claudia, you're right. Pillar 1 will certainly create certain additional taxing rights, which will require treaty changes. Similarly, Pillar 2 would require some changes to be brought in. I do believe that the conclusion of the MLI in 2019 to amend the tax treaties was successful. It was timely and it was efficient. And I think what that has done is it has augmented the confidence of governments around the world that MLIs can be effectively used as a means to rapidly amend the treaty frameworks and bring them to a consistent base. So I do believe that MLIs will form a key part of the implementation plan for Pillar 1 and 2.
Yeah, that's interesting to see, because it was said at the time of the BEPS process that the MLI was very ambitious. How could it ever be agreed? How could you coordinate all these countries and cater for a whole lot of different options? But in the end, they managed to do it, and it's now in force. And I think they've been encouraged down that path now with Pillars 1 and 2, that an MLI type of approach is also the way to get this done very quickly. I think one of the comments I've seen is that they want the MLI for Pillar 1 to be open for signature as early as next year. But it'll be interesting to see when things come into effect, because as Chris observed before, countries might sign up to these instruments, but then their local ratification may take some time to follow. If we look at our polling results here again, there's a bit of a spread, but we do see the audience thinking maybe a marginal impact on centralisation of holding and financing companies. So that's an interesting response. Let's look now, if we move to the next slide, on the analysis and then some practical examples. So we're not going to go through in a lot of detail on the content of the PPT. I assume most people by now are broadly familiar with what's in there. I think the first thing just to highlight, just in our region, if we drop down to the bottom of the slide, just for the relevance of this, the PPT, or provisions to prevent inappropriate access to treaty benefits, were one of the BEPS minimum standards. So all countries had to choose some approach, and you could choose PPT only or a limitation on benefits approach plus PPT. If you look at our region, in common with most of the world, the most popular choice by far has just been the PPT. India and Indonesia have chosen PPT plus a simplified limitation on benefit. But the way that the MLI works, as you would know, that one country cannot force its choices onto another. So the MLI only applies to the extent there's a consistency of choices. So we will be seeing the PPT applying as between the countries in our region for the most part, and the LOB would need to be negotiated on a bilateral basis, not imposed through MLI. So if we recap on what is the content of this PPT, some of you would be familiar with purpose-based anti-avoidance rules that you would already have in domestic law. Australia, New Zealand, I believe India, and a few other countries in our region do have general anti-avoidance rules based on a purpose test, but others don't have those sorts of rules to date, or approach these issues differently. So it's perhaps less familiar territory. Essentially, the PPT is saying that the tax authority can deny a treaty benefit, it's the source country tax authority typically, if one of the principal purposes of the arrangement was to obtain that treaty benefit. So it's giving quite broad authority and discretion there. One of the principal purposes, not the sole purpose, not the dominant or main purposes, just one of the principal purposes. So it would seem to set a fairly low bar for a tax authority, potentially to challenge a treaty benefit. But then there's an exclusion, which is the green part. And the exclusion says, well, unless the granting of the benefit in the circumstances would be in accordance with the object and the purpose of the treaty. This is recognising that treaties exist to give benefits. That's why we have tax treaties, to facilitate bona fide cross-border trade and investment, movement of people and goods, exchanges of goods and services and so forth, and capital. So treaties exist to grant benefits, but it's not permissible for the obtaining of the benefit to be one of the principal purposes. So essentially, it can't be the driver. If we look at the right-hand side, summarising many pages of OECD commentary, some key extracts. You need to consider all the surrounding circumstances, case by case, so you can't just generalise that this type of structure is fine and this is not. Importantly, it's not just an effects test, so the tax authority is not permitted to just say, you obtained a treaty benefit, as in, for example, you got a lower withholding rate or elimination of withholding, therefore that was one of your main purposes. So you can't just look at the effect, you have to look at the purpose of the structure. Arrangements that are inextricably linked to a core commercial activity are generally fine, so that's very important. Arrangements whose form is not driven by the obtaining of a benefit is fine, and we've covered the purpose of treaties there. So you really have to look at why was the structure put in place? Does it make sense absent tax purposes? Is it explicable absent taxes? And then if benefits flow from that, well, then those benefits are the intended benefits of a treaty, because you've got the right type of activity in the country of residence to justify the granting of benefit in the source country. That's the general idea. So if we get a bit more specific, move to the next slide, and we'll look at a couple of, in a sense, case studies. And what I might actually do is start with the right-hand side, which is a very sort of simplistic example of the sorts of, shall we say, tax planning that might have been done a few years ago or in the more distant past. This is showing an ultimate parent in a jurisdiction that either doesn't have a treaty or has a less favourable treaty with the subsidiary, which is down in green there down the bottom in country B. So you've got a parent that if it earned dividends or interest from country B, there would be a higher rate of withholding. This structure then has a holding company in between, whereby now the dividends and interest are flowing from country B to the intermediary jurisdiction where the holding company is situated, and then the holding company pays dividends or interest to the ultimate parent. So a fairly obvious conduit type of situation. To add to the difficulties here, let's say that the directors of the holding company are largely nominee directors, sort of directors for hire, that aren't employees of the multinational group. They're just, they work for, say, a corporate services provider, or the directors alternatively are foreign. They don't reside in the jurisdiction of the holding company. So maybe the people who are employees of the multinational group don't actually reside in that jurisdiction. With this sort of structure, if you had this structure these days, this is really not going to survive, in my view, the application of a principal purpose test, or unlikely to survive, because you've got this holding company or financing company pretty obviously acting as a conduit, no real substance in the holding company jurisdiction, no real reason to have that holding company there that's apparent. It's not owning any other jurisdiction, it's not got any other activity. That is going to struggle to pass the principal purpose test, because it could easily be concluded that one of the principal purposes for that company was to obtain the country B treaty benefit. If we switch to the left-hand side, which perhaps hopefully a more commonplace and a more modern contemporary approach to structuring with reality and substance behind what's going on, we've now got a holding company in the treaty-preferred jurisdiction. But in that same jurisdiction, we've got an operating company with real personnel and assets conducting a trading activity. There might also be a financing company in that jurisdiction that, again, has got personnel. It's got perhaps treasury people. In each of the companies, you've got local directors who actually work for the multinational group. Up in the holding company, you might have regional headquarters personnel and managers and locally resident directors that work for the group. The finance company is raising money from the market as well as from its parent. It's recycling funds from the market into the subsidiaries and then back into other subsidiaries, and you've got multiple subsidiaries as well. So, for example, if country B now pays a dividend to Holdco, rather than it just passing straight through back to the parent, the Holdco takes that dividend and might reinvest it into country A or provide it into the finance company. So there's a circulation of capital that's occurring. There's a lot more that's going on in the intermediary jurisdiction. This is the sort of thing that is much more likely to pass scrutiny under a principal purpose test, because putting tax aside, look at what's going on in the holding and company jurisdiction, the finance company jurisdiction. There's a lot more going on than just nominee directors that occasionally get together to meet, or people who fly in. There's real activity. So that activity warrants the granting of the benefit. Now, that's just an overview. As I said before, it's a case-by-case analysis that needs to be done. So if we move to the next slide. This is just an overview of what we might see as positive factors with regard to the PPT. You might traditionally look at these as being summarised in one word as being substance. Now, the word substance is not really used in the OECD guidance. It's more about these sorts of activities. If we break them into three categories: people functions, which we know are very important in the world of tax these days, not just for transfer pricing; assets and funding; and also the wider context. So in terms of people, you want to be looking at headcount and payroll, seniority and relevant skills of personnel, real decision-making and substantive economic functions. If you've got a big payroll in the relevant jurisdiction, that tends to support that you've got real activity, senior personnel doing real business rather than sort of lower-level clerical activities, as an example. In terms of assets and funding, you want to see the active conduct of a business. You want to see reinvestment, not just a conduit, and having an appropriate capital structure. So if you've got a financing company, it doesn't exclusively raise money from its parent as equity, but it actually goes out into the market and borrows as well. And in the wider context, you're looking at an attractive local business environment, transactions with third parties, and it's just not with related parties. You're dealing with multiple countries, and you've got contemporaneous evidence of all of this as well. And overall, I would sum that up by saying you want to be looking at relevant substance as well. So sometimes a multinational will say, oh, I've got substance in this jurisdiction because there's a bunch of people doing something. But the more sophisticated tax authorities will say, well, that's great that you've got people in the jurisdiction, but what are they doing with respect to my particular jurisdiction and overseeing an investment in the particular jurisdiction in question, rather than just saying, I've got lots of people in the preferred jurisdiction. So there's a bit to think about there, and I think as we move into the next part of this presentation, we also need to think about where all these activities happen in increasingly mobile world with regard to people and capital. So I think we should move on to the next section.
Thanks, Claudio. Greetings to all. Let's open with the third polling question, and it's quite a simple one. My group has allowed or is planning to allow workers to work from home in different jurisdictions on a habitual basis after the COVID-19 pandemic is over. I know the good news is that this question is that we are assuming that the pandemic gets over quicker than later. But we'll be glad to have feedback from all of you. But as you sort of participate in this poll, one of the aspects that Claudio just covered was the people function test for determining substance. And given the fact that in the new world, we will have greater mobility and possibly hybrid working patterns, the impact of that on the people function could be quite interesting to plan. So, Chris, do you have a point of view to offer here?
Yeah, I think that's it's a really interesting thought, Gokul. I mean, if you look back to the test that Claudio just enunciated, in some respects, they're initially designed of a 2013 originally BEPS era. We were still kind of looking at a bricks and mortar style business. When people went to their office, they worked physically in a location, and a lot of the testing comes around of it. But with remote work now, I can be sitting in Hong Kong, but my team members could be in India. They could be Australia. They no longer have to be in the office anymore. They can work anywhere. So some of those tests and relative substance are going to be applied differently, and even beyond people. I mean, you look at business. We're not just doing business in the standard come to my store, come to my office. It's virtual platforms. So it's a little bit interesting that some of these guidance that we've issued, to a certain degree, are going to have to be updated really quickly to deal with this new, rapidly evolving, globalized, digitized business environment.
Thanks, Chris. And as we talk, the feedback that's come in is pretty, it's quite a mixed bag here, and I guess it represents the type of businesses that probably sit in our region, with 30% people agreeing that they could have people across jurisdictions, whereas another 33% say partially agree. So I guess there will be some guardrails happening in those organizations. So, but between the two of them, 63% or two-thirds are going to see some form of hybrid working force emerging. So I think the complexity of how to deal with some of the rules and establish substance using historical principles could be a bit of a challenge here.
Yep.
Yeah. So just moving on, the multilateral instrument specifically moves the needle on treaty terms that have very practical impact on business flows and activities of multinational enterprises. And given that Asia-Pac is now well covered with its treaty network, as Chris covered in the first part of the session, and the MLI adoption has been quite widespread in Asia-Pac, here are four areas where our prior and established understanding will need to be revisited. The first is on dual residency. Place of effective management, or POEM as popularly called, was the tiebreaker test. It continues to be where an enterprise is a resident of both contracting states. So what's changed? Well, as a result of the MLI, there are three sets of changes. Firstly, the provision says that it makes mutual agreement on a determination by the competent authority a prerequisite. Secondly, it allows incorporation and other reasons to be considered in the determination by the competent authorities. And thirdly, it denies treaty relief except to the extent and manner agreed on by the competent authorities. So the impact is that taxpayers do not have a unilateral application of the treaty tiebreaker clause to take the treaty relief. Therefore, when a treaty is MLI'd, that's the new phrase we'll have to probably use for our treaties, then dual residency tiebreaker will need to be taken to the competent authorities for adjudication. Now, I recognize that some such cases are going to be fewer in Asia-Pac as opposed to Europe, where we have seen a presence of far more dual resident entities. Secondly, Article 12. This relates to artificial avoidance of PE via commissioner and similar strategies. Commissioner structures are typically found in civil law countries in Europe as a legal concept. The OECD Model Tax Convention of 2017 had revised the wording of the deemed PE clause to emphasize habitual conduct rather than authority to conclude. These are terms that we were historically familiar with. This revision in the OECD tax commentary is now a part of the MLI, and it amends the tax treaties which have opted in on this clause. The next two, which is Article 13 and 14, are quite relevant in the context of Asia-Pacific. The change in the when and where the exemption for PE applies, which is Article 13, and the situation where there is a splitting up of contracts, which is in Article 14. Let us see which Asia-Pac countries have opted into these articles and then discuss these two changes with case studies. As you look at the chart before you, you will observe the following. Hong Kong and South Korea have not opted in any of these articles. China has opted in only for Article 4, which relates to dual entities, dual resident entities. India, Indonesia, New Zealand have wholeheartedly opted in for all the changes. Australia has opted in for all, but for the article on expanded PE. So with a total of 28 opt-ins from a maximum of 50 on this chart, it indicates that there's a fairly significant set of changes that the MLI is impacting. Article 13, with 70% the countries opting in is significant. So what does the MLI seek to do with Article 13? Quite simply put, double tax agreements have explicit exclusion of defined activities from creating a PE. For example, warehousing of goods. These could stand excluded under the phrase use of facility solely for the purpose of storage, display, or delivery of goods belonging to the enterprise. Traditional tax treaties further elaborated that exclusion from PE would also apply to fixed place of business solely for the purpose of carrying on for the enterprise any other activity of a preparatory or auxiliary character. The covered tax treaties now provide explicitly that a specific activity shall be deemed not to constitute a PE, provided that the activity is of preparatory or auxiliary character. Therefore, the preparatory and auxiliary character test would now be applicable to the explicit exclusions of defined activities such as warehousing. This could impact enterprises involved in complex supply chain where exclusions may have been taken on the basis of the original text of not creating a PE, dehorse the test of whether this activity is core or preparatory. Let's move to the next slide, which is on the splitting up of contracts. In this case study, the assumption is that we have a foreign entity, which in this example, let's take Australia, is going to be providing technology and expert staffing for a construction project, which let's assume is in India. The group has an Indian entity which provides a bulk labor staffing for the construction site activities. In the pre-MLI period, the duration of presence of the group offshore entities continuing for a period exceeding the threshold period, typically 6 months, would have created a PE. Post the MLI, there are two impacts. Assuming that Article 14 of the treaty is applicable to this particular situation, the duration of presence of the group Indian entities at the construction site, which is 150 days, also will be considered in determining whether the group offshore entity in Australia, in this example, will be creating a PE. There's also an indirect impact. The remuneration derived by employees and personnel of the group offshore entity in respect of the EPC work undertaken in India may be taxable in India if attributed to the construction PE so created in India. And many of you will recollect that there is a 183-day rule which excludes individual taxation of expatriates if there is no attribution of their salary to the PE in India. Such a deemed construct of a PE in India could also then limit their exemptions. In addition, there are a number of judicial precedents which have been used to establish what happens in a subcontracting situation. A number of these will need to be revisited as a result of the changes. Moving forward, you would probably recollect that the Mli negotiations were concluded at the end of the calendar 2016 and came into effect in the summer of 2018. Most of the countries filed in their accession in 2019, as Chris had outlined. By early 2020, the world was impacted by the outbreak of the pandemic. This has led to guidance from the OECD and various jurisdictions to tackle the tax issues arising due to travel restrictions. The interplay of the MLI, which came nearly concurrently into force, and these temporary guidelines has created a set of outcomes which needs significant attention for correct application, such as the impact of home offices established under jurisdictions, the disruption to construction site activities, cross-border workers, etc. Let us look at one such example on the next slide. Let's assume that on the 1st of February 2020, individuals from Australia came to India. On the 12th of March, a month and 12 days later, the individuals were quarantined in India on account of COVID-19. 25th of March, last day of quarantine for the individuals. 26th of March, they were unable to leave India on account of the travel restrictions imposed by the government of India on account of COVID-19. This was actually a live case study insofar as the first year was concerned. The Indian financial year comes to an end on the 31st of March. However, it was only on the 13th of July that travel restrictions were lifted by the Indian government. The individuals are unable to travel back to Australia on account of travel restrictions imposed then by the Australian government because of COVID-19. Here we've gone ahead and tried to extrapolate a few more assumptions into the case study. 28th of September 2020, travel restrictions were lifted by the Australian government. But on the 29th of September 2020, the individuals continued to stay in India because of the internal policy of the Australian employer. It's only on the 2nd of November 2020 that the individuals left India. So the question really comes, what happens to the residential status of the individuals in India in the financial year 1920? And what happens to the creation of a PE of the Australian entity in India in both 1920 as well as 2021? The answers here are as follows. There's explicit guidance from the Indian tax authorities that the stay days in the financial year 1920 for the period of quarantine and the period that they could not move out for the purposes of travel restriction will be excluded from being added in for determining the residential status of the individuals. However, there's no such explicit ruling by the Indian authorities for the creation of a PE. In financial year 2020-21, again, there is no explicit guidance either on the residential status or the PE by the Indian authorities, and hence the standard rules will apply unless there is a petition seeking for explicit exemption to be given to those individuals. So therefore, we will see that in the case of only one situation that there is explicit finding that the residential status of the individuals in India in 1920 will be excluded from taxation, whereas in 2021 it will not be so. This explains as to how different outcomes can get created on account of the interplay of the COVID pandemic related regulations. I'll now turn to Claudio to talk about the Australian experience had this case study played out in reverse, with Australia being the recipient country.
Thanks, Gokul. Yeah, that's an interesting question. Like many tax authorities, the ATO has published some guidance on the impact of COVID and whether there might be PEs recognised. In general, the ATO's guidance is in line with the OECD guidance, and essentially it's saying that if people are present in Australia solely due to COVID travel restrictions, then that of itself is not going to be considered to give rise to a PE. That's the policy that they've got at the moment. As long as the presence is due to people being stuck in Australia effectively due to travel restrictions, and that they will relocate overseas as soon as practicable following relaxation of those travel restrictions. So that's our government's point of view. The question remains, what exactly do those travel restrictions mean? Because the guidance doesn't specify whether it's due to, say, government restrictions or perhaps the individual policies of companies, which I know that some companies, having discussed this issue with them, they are being more conservative than government restrictions because they don't want their personnel to travel unless they absolutely have to from a health and safety point of view. So even if technically you could overcome a travel restriction or make an application to overcome one, in practice, a company simply might have its own policy. So I think questions will arise in those sorts of issues, and the longer this goes on, the more the question will arise. At the moment, the government policy is in place, or the ATO policy, until the end of this calendar year, and then they're going to revisit. And based on our recent announcements, our own government's announcements on the travel, it seems unlikely that there'll be much ability to travel into or out of Australia until the new year, unfortunately. At this point, it's still highly restricted. So that's the situation at the moment, but it's something to monitor. I think I'll finish on this note. What the ATO officials have told us, one thing they'll be looking for is recognising that COVID and remote working, these changes are now becoming more common. They want to differentiate cases whereby people are temporarily stranded in a place from cases where the business practice has now changed and people will be based in a new jurisdiction. It could be in Australia, it could be elsewhere, and work remotely in the long term. They do not want to provide this kind of transitional or temporary circumstances relief where what's actually happened is there's been a permanent change in the way people are working and doing business. So that is something also to keep in mind.
Thank you, Claudia. That brings us to another quick polling question, which is that in relation to all of the changes that have been proposed by MLI, do you or in your group considering to implement or considering to change your contracts as a result of the changes which have been proposed? So while we look for the response, Chris, I know you work a lot with the energy industry. Are you seeing anecdotally changes being proposed to how the EPC contracting structures are being proposed to be implemented?
So Gokul, not yet is probably my fairest answer. Obviously, things were suspended, a lot of the activities over the last year, and then I've kind of just restarted. And then with the overall change in the energy industry to kind of transform to all the new carbon initiatives, there's been a lot of other, I'll say, maybe more pressing things, but it has definitely come forward. I think initially people weren't as concerned, but as we get into new contracts, some of these large EPC contracts, it is really a key concern because often the major engineering firms otherwise have to secure those capabilities from multiple places around the world. So it is definitely on the horizon, and so I think going forward it's going to be a very, very key thing.
Wonderful. So a lot of people seem to be influenced by your response, Chris, because they are also agreeing with the fact that they can't say, too early to say as to whether changes are going to happen, 46%, with 25% saying, well, partially agree, there will be some changes happening to the contracting structure. So I do believe that there is change in the offering that's likely as greater clarity comes in, or when greater clarity comes in.
I think so.
Over to you, Chris.
As we go through the session here, we've gotten a few polling questions from our audience, and I know we're getting closer to the top of time, so I want, if I can just interject and answer maybe a couple of these questions from our audience, because there's some really good questions posed to us today. Claudia, maybe I'll just turn to you for the first question. When you're talking about PPT, the one thing we didn't raise was beneficial ownership. That used to be a topic of discussion a lot in the past about obtaining treaty benefits and the importance of beneficial ownership. Any thoughts on that and kind of where we stand on that situation today? Oh, Claudio?
Sorry about that. You can hear me now? Thanks,
yes.
Chris. On your question on beneficial ownership, I think that very much depends on the eye of the beholder, because I think different tax authorities have different views on what that concept should mean. If you look in the OECD world and the OECD guidance, back in 2014, some guidance came out that actually restricted the concept a fair bit in the perspective of, in order to have a problem with beneficial ownership, there would need to be a contractual obligation or other legal obligation for the recipient of the income to pass it on to someone else. Now, if you recall the example we went through before, if you've got a holding company that receives, say, a dividend, the holding company doesn't have any obligation normally to pay a dividend, because the dividend is inherently at the discretion of the directors and subject to the availability of profits. So with regard to dividends, it's difficult to have a problem on beneficial ownership on the OECD view of the world. Now, we know that some other jurisdictions, say China, for example, they have guidance on the meaning of beneficial ownership as the Chinese authorities see it. And effectively, they see it more as akin to a principal purpose type of test, where they look at all sorts of factors that point to whether there's sort of real substance in the entity that claims to be the beneficial owner. So I think the impact of beneficial ownership depends on the jurisdiction that you're looking at as the source country. But it's certainly right to say that some countries, you have to jump over that hurdle first. You need to make sure the holding company or other company that's claiming treaty benefits is the beneficial owner. And then you get to, if you pass that, you then got to pass the principal purpose test.
Yeah, so still very relevant. We just added additional layers of testing we have to go through.
Yeah, exactly.
Excellent. And I see we got another question, and I want to pick on this one because it's actually one of my favorite questions I've been getting a lot lately. One of our listeners asked a question around the storage of materials for sale, in this case in India, in a free trade zone by a foreign company, and whether that will now be constituted to be a P in India. Gokul, I'm going to ask you this question, but I'll give you a second to think about it. But I'll give a context. I've had this question a lot in places like China. And the question is, hey, we got a free trade zone. Does this mean something has changed? And I guess what I would start the conversation by saying is, at least in a China context, it's important to remember that in a free trade zone, that gives you freedom, and you don't pay indirect taxes. You don't pay customs duties, or you don't pay VAT until it leaves the free trade zone. It is not a free income tax zone, though. You're still subject to income tax rules. But often we would have said, well, because of the old treaty provisions, storage of goods was not a permanent establishment. You're okay. But I think exactly to Gokul's point, with the new MLI, you need to revisit that position in the use of your warehouses and your free trade zones, because you may no longer meet that auxiliary or preparatory exception. Gokul, is it the same in India?
Pretty much so, Chris. With regard to the specific free trade warehousing zone that is being sought by Vijay in the question, I am also not aware of any direct tax exclusions that were explicitly provided in that scheme. But of course, it makes sense to look at that, the fine print of that scheme, to make sure that there is no such exemption domestically provided. And the second thing to look at is the Indian treaty with Belgium, and to see whether both of them have elected in and opted in on this clause. India certainly has, but the treaty stands amended only if Belgium too has opted into this clause. So I would suggest that we request Vijay to actually have a quick look at the Belgian treaty and the MLI provision. And then, he'll probably get the answer after he does that test.
Yeah. Okay. I see. So we have time for one more question, just a quick question. Claudio, I'm going to turn to you on this one. And it's regarding your discussion you said earlier about the holding company and whether, in the third jurisdiction to get, arguably to obtain treaty benefits and the use of foreign directors. Would your answer change at all if a non-executive director or an NED was used versus just some sort of service company, or does that change things at all?
Yeah, I think it could, Chris, because it depends, as we said, on the circumstances. So the observations that I made about nominee directors is more along the lines of, let's say you've got a sort of corporate service provider that provides directors for hire, but perhaps in some cases that we've seen, those directors wouldn't really necessarily fully turn their minds to the matters that they're being decided, or act more as a rubber stamp, more of a ceremonial kind of role. That, I think, potentially ends up in problems. Whereas if you had in your regional holding company a non-executive director who was, an appropriately qualified person that perhaps used to work in multinationals and experienced and would understand and properly consider the matters put in front of them, then that's fine. Just because they're not an employee of the group, that doesn't mean it's a problem. We're more alluding to the type of situation where you've got a board of, say, 4 people. One of them is a senior executive from the group parent from the home country who flies in, and 3 of them are say, local nominees who perhaps really just do what they're told or tend to just follow whatever's put in front of them rather than bringing an independent mindset to things.
Yeah, exactly. All right, thank you. So that brings us to the top of the hour and the end of our webcast today. So Goko, Claudio, I want to give a special thank you to both of you for joining us today, and a special thanks to all of you who were able to join us today. If you'd like to, we'd like to encourage you to fill out our short survey that will pop up on the screen momentarily and tell us what you thought about today's program. If you joined us late, please note that this presentation will be archived for future viewing. And if you feel that others would benefit from this webcast, please feel free to share this webcast via the share this icon or have them visit our debriefs website. We were not able to answer all the questions today, so we will respond to those questions shortly after this program. And also, if you think of any other questions or comments, please feel free to reach out to myself or any of our speakers. We're more than happy to talk with you about those questions. And please don't forget to tune in to our next scheduled webcast from our corporate income tax series. It's going to be on July 27th. We gave a bit of an introduction to that today. It's going to be on the OECD G20 Pillar 1, Pillar 2 project. So I think very, very exciting topic. So we look forward to seeing you then. And last, but definitely not least, thank you from us at Deloitte. Thank you for your participation. And we look forward to seeing you next on July 27th. Have a wonderful afternoon.